Good afternoon, ladies and gentlemen, and welcome back to the SIAS Corporate Governance Digital Symposium. Today's topic is dealing with a crisis, communicating with stakeholders effectively. And what crisis are we talking about? Specifically, the COVID-19 crisis. A recent Brunswick report highlighted that 80% of employees and 90% of financial readers expected to hear the CEO on social media during a crisis. The current COVID-19 pandemic has required many companies to change the way they communicate with stakeholders. Now we have Zoom meetings, we have virtual AGM meetings. How do companies prepare themselves to deal with such crisis? Are we prepared? What about other risks like cybersecurity? To take us through some of these questions and how we manage stakeholders effectively, we have with us today Ms. Prue Bennett, partner and Brunswick Group. Some of you may know Prue. Prue is no stranger, and she's been with us at several of other conferences. She previously was with BlackRock Investments as the head of stewardship. Today, she's a partner of Brunswick Group, assisting Australian and Asian corporate clients on issues related to corporate governance, ESG strategies, stakeholder management, and communications. Could I please welcome Prue, please? Thank you.
Thank you, Richard. And look, it's a pleasure to be asked to speak to this conference. I've been speaking at the SIAS conference for a number of years, and it really is a global leading conference in corporate governance, in my view. And as Richard said, today's topic is communicating with stakeholders effectively. And it is such an important topic because when there's a breakdown in communication in a crisis, it can have serious impact on shareholder value. Compared with when that communication is managed effectively, it can help maintain and in some cases enhance value in the case of a crisis. Have the next slide, please. So I'll be looking at this topic in two lenses. First of all, as a partner at Brunswick Group, which now I'm actually an insider in companies, meeting with the board and working with the board on governance issues, and also in my previous role as an investor, where I was engaging with board and C-suite on these issues, and particularly in times of a crisis would have to engage with the senior leadership team and sometimes work with them and really understand what the issues are. And this is where I've really learned how important that effective communication is. So Brunswick has been involved in assisting clients for more than 30 years around issues of crisis. So what have we learnt from our experiences over that period of time? That crisis can be an opportunity for the leadership team to drive change. And this is very much the case when the crisis comes from an external event such as COVID-19. And I don't think there's been any other event in my lifetime anyway that has really brought attention to boards and senior leadership teams about a crisis than COVID-19 has. And how a crisis, whether originating from internal issues or an external event, is managed is seen particularly by the investor community as a litmus test for management quality. For companies that have built strong relationships prior to a crisis, they will start in a much higher place with a much higher level of trust or social license than those companies that haven't built relationships with stakeholders. And it's very hard to build trust in the midst of a crisis. And being prepared cannot be underestimated. This allows for swifter and more thoughtful responses to a crisis, and again, a test of leadership quality. And building muscle memory is critical. Next slide, please. Understanding your risk landscape is essential. And just on the right-hand side here are 12 examples of what might be on the risk register that, if not managed or if the crisis comes up, really companies need to be prepared for. And one thing I can say is that the number of issues facing companies today in terms of becoming a potential crisis has changed and are ever increasing. Technology is just an example. 20 years ago, cybersecurity was probably not on a company's risk register, nor short sellers. But these are two issues that, if not managed well, can result in serious destruction in value. The first step is to identify what you need to protect and prioritise by identifying those issues that will have the greatest impact on your reputation and really understand why. This should be approached from the perspective of your company and your stakeholders. Identification of stakeholders and their importance to you is key. Stakeholder mapping is something that should be undertaken on a regular basis, as not only stakeholders change over time, but so do their perceptions of your companies. And make sure you understand and respond to all your stakeholders' concerns, and not just the loudest ones, such as media and investors. And don't overlook your employees as a key stakeholders. Employees are your external facing and most important advocates. Make sure they understand the company's positions and how they can respond to questions about a crisis. A critical task is simply knowing the facts. This will allow you to act quickly, transparently, authoritatively, because you are acting on the facts of the issues and not just hunches or worse, emotions. And you'll be in a strong position to understand the impact of the crisis on your stakeholders. It is also important to understand that not all issues turn into crisis. That understanding comes from knowing your stakeholders and having the facts. Next slide, please. I've mentioned the term stakeholders many times, and your stakeholder universe is large and also complex. An error many companies make in a crisis is to be focused on only a single stakeholder group at the expense of another. So broadly speaking, stakeholders can be divided into four main groups. Firstly, the providers of capital, your investors and financiers. Secondly, social. Involving public perception can have a huge impact on shareholder value through the loss of sales or the loss of the ability to win contracts. Once public sentiment is damaged, companies can find themselves in a very steep slope to recover. It is very expensive to recover from that loss of sentiment. Regulators are more prepared to take separate and challenging views to business. And from a political perspective, politicians and governments want to be seen to be standing up for business. It is very important to understand your stakeholders and also the granularity of stakeholders within those groups. Next slide. Recent global developments have impacted stakeholder engagement and raised the stakes for boards, and in particular, the impact of COVID-19. The impact on COVID-19 on some businesses has been catastrophic. While most large companies and had business continuity plans in place, there was no expectations that such situation would continue for months. This has raised issues for boards and board resilience, including overboarding. Boards used to meet prior to COVID-19, some as low as 4 times a year and others up to 10 times a year. But for some, weekly board meetings became the norm during the initial part of the pandemic. For those directors sitting on 6, 8 and up to 10 boards, this would have been impossible for those to commit the time to those companies and do the right thing for their shareholders. The other issue that has come up for boards is the diversity of skills, so that the board is in a position to provide the senior leadership team with the appropriate oversight and counsel that they require in the time of a crisis. So does the board have the right skill to survive a crisis? And I think this is the question that many boards need to be answering. The resilience of directors and the board as a whole to cope in a crisis has been highlighted as a key issue. And I'll never forget a conversation I had with the chairman of a company that had been through a major crisis. And he stated that the most desired attribute of a director is resilience under pressure. And it was always in his interview technique was to ensure that the directors that were on the board that he was chairing really had that resilience. The pandemic has also highlighted ESG issues and sustainability. Contrary to the idea of ESG as a bonus to be applied during bull markets, coronavirus is creating a sustainability crisis that shines a spotlight on how well companies are run and the resilience of businesses during this challenging period. It has also been an acid test for board and senior leadership quality. The management of human capital has been a major issue. Mental health issues arising from employees working from home for long periods of time is a new challenge and a new risk that will appear on the risk register, and an issue that cannot be ignored. And working from home has also highlighted data security issues and other technology issues that probably weren't considered prior to the pandemic. Next slide, please. When managing a crisis, effective communication is key, and here are 6 principles to follow. Establish your view of what is happening. If you can project that view from the outset, it will give you the credibility to your response. Make sure your company is a credible source of information about the crisis. Only state what you know, but make sure you are ready to fill the void. Otherwise, other people or the media will define that narrative for you. Act fast and don't panic. There is a need to balance speed and patience with restraint. Note that the media is a symptom of crisis and not a cause. The media is usually not the most important stakeholder, even though they might be on front of mind and most of the time, and you can't help but worry about what will be on the front page of the newspaper the next day. Focus on solving the problem and don't try and resolve PR. It's much more important that a crisis is dealt with in its entirety, that people are safe and the organisation is stable. Avoid underplaying the problem or overpromising the solution. Such actions will impact your corporate reputation, which is a key asset. And as I mentioned before, once corporate reputation is lost or damaged, it takes a long time and a big investment to rebuild. Next slide. Don't forget digital. We are now in the digital age. In October and November of 2019, Brunswick surveyed 422 senior investors from around the world, comprising both buy-side and sell-side. And what that showed was that digital sources are core to how investors investigate an issue. And 98% of investors use digital sources to investigate issues. And this is up from 77% in 2014. And information from digital sources fuels real buy-sell choices. 5 years ago, only 41% of investors were using digital sources to make investment decisions. Today, 75% are doing so and likely to rely on search engines, blogs, newsletters, and podcasts. Investors still want the C-suite to be online. Investors do not only want to hear from the CEOs, but also C-suite and the chairman wherever possible. And from a global perspective, having that chairman engage with key investors, institutional investors on an annual basis is really becoming the norm. The traditional focus on a handful of key media outlets is no longer an effective way to reach investors. Today, it's imperative to go further. Digital also gives you the opportunity to drive the narrative. Being prepared is a virtuous circle, and it's not just a box-ticking exercise. For a company to be well positioned to respond swiftly and authoritatively in a crisis, it needs to ensure that it has an up-to-date playbook and materials. It also needs to ensure that crisis leaders and their teams are continuously trained and tested. It's just not good enough to have the playbook sitting there on a shelf. because in a crisis, people aren't going to the shelf to pull that book out and understand what needs to be done. There needs to be training and testing and proper education about how things are to play out. So preparedness involves assessing your materials and processes to ensure they are fully up to date. Pressure testing response skill and processes through simulation and workshops. Prioritise investments that are needed to optimise crisis response capabilities. In terms of responding, tweak messaging and supporting materials according to the situation, and find and execute the pivot. And turning to recovery, assess your response using quantitative and qualitative benchmarks, develop long-term reputational objectives, and build a campaign plan. Next slide, please. I think we might be missing a slide. Let me just go back. Yes, that one. I'd like to touch on two cases, in particular BHP. In 2015, there was a major dam collapse in, it was the Samarco, BHP Samarco business in Brazil. At the time, I was head of stewardship for Asia Pacific for BlackRock, and BlackRock was the biggest investor in BHP at around 7%. And I remember walking into the office that morning, and one of the portfolio managers came up and told me what had happened, and I looked at the incident on the internet and was just horrified with what I saw. And one thing I did know, that I had been engaging with the chairman of BHP for 6 years prior to that. So I had built up that trust with the chairman, and I knew that that board and the senior leadership team would be doing whatever had to be done. And I was fairly right. And I just want to identify some of the actions that they took that gave me, as representing one of the biggest investors in BHP at the time, the confidence that this crisis was being managed in the best way possible. There was a rapid apology from the CEO even before he left Australia to go to Rio. The CEO chairman travelled to the site as soon as they could. They were never defensive, and nor did they blame the joint venture company, which they did not manage. So they were part of a joint venture with Vale, and Vale was the manager. At all times, investors and other stakeholders were kept informed about the progress of what was happening. There was an announcement of a demonstrably independent investigation into what had happened, and an undertaking by the board to respond to the outcomes of that investigation. Not long after the incident, BHP announced a change to their joint venture management that would ensure that for any joint venture project, BHP would be the manager. And I think this sort of contrasts a little bit with Rio. I think everyone should be fairly familiar with what's happened with Rio Tinto, that 3 senior executives are stepping down before the end of the year. And in this case, for those that don't know what had happened, Rio Tinto has a lot of land in Western Australia where they mine iron ore, and to be able to extract the iron ore often involves blowing up rocks to extract the iron ore. About 3 months ago, they set off several large explosions which destroyed some caves which had a 46,000 year history to the local Aboriginal people. And so there was a lot of concern by both the local Indigenous landholders and other stakeholders around this incident. And so for this case, it really was the S, or the social, that became relevant. And this incident happened at a time when companies globally are grappling with how to address other social issues like racism and inequality. And in Australia, this is focused in particular on the treatment of Aboriginal people. It is important to understand that these issues are no longer dealt with by sustainability teams, but they are boardroom and C-suite matters, and should be on the risk register and have oversight of the risk committee and ultimately the board. It's also a clear indication that we have moved on from a world where profit is king, and the CEO can no longer hide behind strong financial performance. Rio's share price in the 6 months prior to the incident had been performing very well, and in fact it had been up 40% in the 6 months prior to the incident. And that this was not enough to protect the CEO's job. Investors, and predominantly Australian pension funds, are less focused on immediate returns and instead taking a longer term view in line with their beneficiaries. And they expect their companies to do the same, and this includes building and retaining social license to operate, something they will need in order to succeed over the longer term. Rio tried to deal with the matter with a financial fine that was reducing the bonuses for the FY20 year to zero for 3 key executives. And the company looked to attribute a value to the destruction of this sacred site and missed the mark by really not understanding their stakeholders. So this really is a lesson in how important it is to identify and listen to your stakeholders. Listen to what they care about and make sure you care about it too. Companies often do not understand the difference between asset owners and asset managers. And it's the asset owners, the world's large pension funds, that are very much focused on these longer term non-financial sustainability issues. And they are increasingly taking responsibility for stewardship of the assets on behalf of the beneficiaries. And it was the Australian asset owners that put the pressure on the board to make the decision around the termination of the roles of the 3 senior executives. If we could go to the last slide, please. Thank you. And I'm just going to finish with this quote because I think it's really sums things up quite nicely. Crises are not manageable. They are, however, survivable and usable. What an organisation needs is the resilience to pull through and the flexibility not to waste the opportunity a crisis presents to make important changes. So thank you very much for the opportunity to present to you, and I look forward to participating in the panel discussion. Thanks, Richard.
Thank you, Prue. Actually, every time you join us, you're actually looking younger and younger each time. You know, you've been here for several years.
You.
And you bring such
Must
great...
be Zoom.
Yeah, and you bring great insight. And I wanted to share this little finding that we had as well. And you're right, about bringing in a lot more of non-financial research among retail investors. And 85% of retail investors surveyed say that they actually are using more non-financial information to make investment decisions. So this is something that, you know, companies should also be very aware of. And I think we'll carry on further with our panel. Could I just welcome our panel here? I'll just introduce our panel this afternoon. First, we have Mr. Chin. He's the Managing Director, Head of Regulatory Development and Policy Strategic Planning Office, SGX Regco. Welcome, Chin. Mr. David Gerald, who is the founder, president, and CEO of SIAS. Welcome, Mr. Gerald. Ms. Grace Chen, Relations, CapitaLand Limited. Hi, Grace. Good to see you again this year. Mr. Patrick Ang, who is the managing partner of Raja & Tan, Singapore LLP. He's also the vice chair of Raja & Tan Asia. Hi, Patrick. Welcome. And of course, we have with us Ms. Prue Bennett, who is also on the panel addressing further questions. We have our moderator this afternoon, Mr. Loh Wan Chen, who is the Vice President of SIAS. He's also the CEO of Black Sun Asia Pacific. Over to you, Wan Chen.
Thanks very much, Richard, and good afternoon, panelists, and good afternoon, participants for the event today. Before we kick off, can we have a couple of words from David, Chairman, Founder, CEO of SIAS?
Thank you, Wan Chen. If you say a couple of words, you know me, I'm likely to be more than a couple of words, but I know I'm conscious of the time. Good afternoon, everyone. About 540 registrants for this session, the highest so far, but we've got about 200 already in. And therefore appears to be a very keen interest on this topic, Wan Chen. I would like to thank Prue for joining us from Sydney. And we've got an excellent panel for this session. So I'm going to share my experience at SIAS very briefly within the time that given to me. You all know that SIAS emerged from a major crisis in 1999. All right, that was a huge crisis, and that was between two governments, two countries, involving 172,000 investors. Now, a crisis that revealed that most crises could have been, avoided or nipped in the bud, but it was a financial crisis, and from the Asian financial crisis, club crisis arose. So an issue becomes a crisis when the board and management let it fester, hoping it will go away or think they can deal with it later. This is something I've repeatedly seen. A crisis can be diffused by a willing board and and management by listening to the aggrieved party and genuinely working with them for a win-win solution. In the days gone by, when I started SIAS, they were not willing to, most of the company boards would say, we will talk to our lawyers, we will talk to our financial advisors, and then we will decide what to do. But over the years, companies have learned the art of communicating with shareholders on SIAS platform, on their own, in their own conference rooms or at meetings, dialogue sessions. And that is an interesting development, because by listening to the aggrieved party and genuinely working with them for a win-win solution is the way to go. So there must be a genuine desire to address the grievances. So the aggrieved party must feel comfortable and willing. So we all know what happened in Enron, China Aviation Oil, High Flux, there's a litany of, names. But in Singapore now, we find that things are much, much better, but you will find, very often in the Business Times column, Professor Mark and others write about companies that are still not willing to do things right. My only hope is that they will all communicate effectively. On Monday, I highlighted some of our observations of companies we communicated with during the AGM season. Now, for the benefit of those who missed it, let me just briefly recap the points I discussed about how companies can better communicate with the shareholders during the pandemic and moving forward. This is very important. For an effective solution, for a crisis to be managed, and for a crisis not to become a monster, another crisis, a bigger crisis, they need to communicate well. Prue has outlined the 6 principles of effective communication. So I will not revisit them. However, for the annual reports we reviewed this year, we find that companies do need to improve communication, and perhaps in the following ways. They need to be clear and direct. Right? In times of crisis, Wan Chen, companies should not shy away from reaching out to their stakeholders without delay and tell them fairly and squarely what the issues are and what the company will be doing to overcome them, or whether they can or cannot. Be honest, be frank. All right? State the facts and provide clear explanations, especially when addressing difficult issues like financial losses. When things go wrong, some of the directors tend to hide. Okay, that's when the trouble starts. The media picks up, the shareholders become anxious, activism, starts knocking at the door, and they find things have gone out of hand. They could have nipped it in the bud. All right, do not mislead your stakeholders. Nothing is worse than finding, the shareholders finding out the truth, which must come from you and you only, from the company. Let me tell you, in one company, the chairman went all out to highlight the positive points of the company and spent a lot of time praising how well the management has done. This is in spite of the company making losses for several years. And he had the audacity to say we have done very well, In fact, the loss was not even mentioned until you flip over 30 pages into the annual report. Today, shareholders, stakeholders are not stupid, you know. They will find you out. So my advice to companies is provide a fair and balanced report on their status truthfully and be clear and direct in your communications with stakeholders. Stakeholders are now, these days, quite discerning. They are educated. They are investment savvy, you know, and crisis becomes worse when you hide and dodge. Be honest, manage the crisis, all right? And the second point is make timely disclosures of the risks. Very often this is missing, you know. If you really flip through the annual report, I'm sure, Wanchan, you look at many annual reports, you will find there isn't a defined disclosure of risk in the annual reports. So we are particularly—
Yeah, it's very high level, yeah.
Yes, you know, we are disturbed by the lack of disclosure of key risks and associated risk management strategies. Companies must not just comply with the letter of the law, but must strive to comply with the spirit of the law as well. Here I must quickly add that the TLCs, you know, the big caps amongst them, the blue chips, they are doing well because they have resources. I'm talking about the rest. All companies just comply with the regulations like listing rules, but do not go the extra mile. To illustrate this point, our business integrity research, which we launched on Monday or published on Tuesday, revealed that there is a gap between disclosure and practice. So perhaps companies are getting too used to just doing the same old things. And furthermore, they worry about compliance costs. Okay? In our view at SIAS, in our view of companies, through the Q&A exercise on annual reports, we note that some of companies lack making timely disclosures, especially on key risks. For instance, SIAS questioned one listed company recently. I think you all will know this, the name of this company. They ran a foreign worker dorm, which was designated an isolation area for not disclosing this fact. Companies should make timely and meaningful disclosures, not just materially price sensitive, but trade sensitive information as well. So this means that companies have to disclose information that will influence an investor in deciding whether to buy, sell, or hold securities. So from our corporate governance research, you know, the big cap companies are ahead of the pack, especially the TLCs. But there are companies who are still not engaging shareholders and stakeholders effectively. You know, maybe they feel that, you know, they'll be under a barrage of questions, accusations, they shy away. Huh? Not many, quite a few there. So this pandemic has also seen many companies conduct capital raising and other corporate actions to shore up their balance sheets. However, companies should continue to engage their shareholders and stakeholders to provide them with a rationale for their fundraising and to account for their use of funds. All right, there must be a very clear account given of the use of funds. Now, there is social distancing now, but that doesn't, you know, be an excuse for them to engage with shareholders in the digital era. You know, I'm surprised that I now am able to communicate with my members through and shareholders and investors through the, you know, digital means. So if I can do it at 76, I'm sure the younger directors can do that. You know, let's take the Singapore Airlines experience. The rights issue, you know, recently is one such good example, which was conducted during the very difficult circuit breaker period. How did they communicate? They wanted to launch the right issues, but SIAS revised the circular and sent questions to the SIA regarding their planned fundraising and rights issues. SIA responded to the SIAS questions in a very timely manner, and we even recorded a dialogue with the CEO, who was willing and ready to take all questions. This is a good example of effective communication and willingness to reach out to the shareholders. So in a crisis, this is very important. It served SIA well. They got it through. With technology today, having engagement and taking questions live from shareholders should be part of any listed company's standard operating procedure, you know. So the fact that you're doing it through digital must not stop you from taking questions. Shareholders come to meetings to post questions. All right, so many shareholders have voiced their concern and not being able to have their votes counted live, and lament that they could only vote via the proxy. They also shared their concern with us about not being able to have live Q&A with the company. The situation is only worsened when their questions and concerns are not addressed by the company ahead of an EGM, where shareholders' vote will determine the outcome of a resolution. All right? So what I want to say is the corporate governance code encourages companies to communicate through events like Investor Day, which we have been doing with some companies. You know, Capital Land Group is very famous for this. Singtel, Keppel, and others like hold Investor Day annually. Why? They want to meet their shareholders. They don't shy away from the shareholders. Ask all the difficult questions. Help us to understand what you want. More and more companies are using our platforms to reach out to their stakeholders to address worrying issues. And let me tell you, over the last 18 months, SIAS has held almost 47 dialogue sessions, benefiting both the company and its shareholders. You know, we encourage very frank face-to-face discussions. So there is now a rise of shareholder activism, which is good for our capital markets. You see, we observe finally the increase in shareholder activism activities, and the tactics and strategies are changing too. No longer can companies put on lavish meals, you know, a good spread in the hope that shareholders will flock to the buffet instead of focusing on the company's affairs and resolutions at the meeting. Those days are gone. Maybe there's a handful who still like, you know, tapao and food, but most of them stay behind to ask good questions, you know. There are more institutional investors and hedge funds investing in Singapore listed companies. This is a testament to the growing attractiveness to the quality of companies in Singapore. However, are companies prepared for this new breed of investors? How do you engage them? So companies should take a critical look at their businesses as an activist would, look hard for underperforming components. They should understand which activists might be interested in or attracted to the company and why. They can better understand the shareholder base and have a tailored engagement plan. Any gap in your communication or disclosures will be met with action from these activists. All right? So if a company thinks that shareholder activism is only by hedge funds and institutional investors, they have to think twice. They are mistaken, because today individual shareholders are also actively seeking greater accountability from boards and senior management. All right, testament to the growing number of EGMs called by individual shareholders who are not afraid for a full-blown proxy contest that seeks to replace the entire board. So let me conclude my remarks. Fundamentally, the culture of the company is established, as you know, by the tone at the top. We all know that, which determines how a company engages with its stakeholders. However, when a director does not act with integrity and doctors a picture to change the context, what is the signal for the rest of the staff in the organization? Creating and maintaining the right tone at the top is the bedrock of a robust ethics and governance within an organization. Wanjan, those are my couple of words.
Thank you very much, Chairman, Founder, CEO, SIAS, for the opening remarks. As always, very in-depth, very good guidance, David. Thank you very much for that. What I'd like to do now is to invite the panelists to give their views. We have a few questions that we'd like to ask the panelists, and we'll start with Patrick, then we'll go on to Grace, Chinyi, then Prue. History repeats itself. It's a very old saying. We know what we should know, and we should not be surprised. But yet, a crisis happens, and we get caught with our pants down. So maybe, Patrick, we can start with you. What makes a crisis a crisis? If history repeats itself, there should not be any crisis. What's your view, Patrick?
Hi, Wanchan. Yeah, thanks. Thanks everyone for coming on to this session. As a restructuring lawyer, a lot of the cases I meet are obviously companies in financial crisis more than any other type of crisis. And what I've realized is that when I deal with these companies, practically I would say from my experience over 25 years doing this work as a specialty, practically all the companies I dealt with do not have a crisis plan. So it's quite ironical, I find, that there are companies, obviously, there are companies with crisis planning, with business continuity planning and programs and all that. But these companies end up not in trouble. But the companies which end up in trouble are the ones who are not prepared for it. So that's the first observation I make, which obviously means the lesson for all of us in business is it's better to be prepared than not. And we should never say that this will never happen to our company. It only happens to others.
To somebody else, yeah.
Yeah, correct. That's I mean, common thinking that problems only occur elsewhere. It doesn't happen in my company. But I think cybersecurity is a good example, probably the best example, where I attended a conference and the expert said, there's no such thing as companies who have been hacked or companies who have not been hacked. The only difference is companies who know they have been hacked and companies who do not know they have been hacked. And I think that's the same for crisis, that the boards who are better managed are the boards who know of the risk and try to anticipate as best they can, not obviously 100%, but as best they can to anticipate the crisis before it happens. I just want to make one more point, if you don't mind. I want to make the point that crisis can sometimes be dealt with, all right, without resort to the law. So I'm saying this as a lawyer, even though this goes against my business. But I give you one case study which I happened to chance upon while one of my read-ups. There was a company in Japan, Western company, operating lifts in Japan. They had a lift problem where the faulty brakes caused a fatality. A 16-year-old boy died because the lift company's brakes were faulty. This was apparently in 2006. The company took the approach, instead of coming out to apologize to the Japanese public, which would have been very well received. They obviously took legal advice that they should not comment. They took the advice that they should resist. They should explain away. The matter was unfortunately brought to a civil court, thankfully not criminal, and apparently they lost. So that was, I thought, a good lesson that law alone sometimes is not the answer. One has to look at the risk holistically, and sometimes it's better to deal with the crisis early, as David alluded to, rather than resorting to the law, fighting, and then in the end, ending up worse and causing a bigger crisis than if the matter had been dealt with earlier. So those are my 2 points.
Thanks, Patrick. Before I go to Grace, maybe just respond for your remarks, Patrick. You're talking about the lack of preparedness that will all inevitably lead to a crisis. Who should be responsible for preparedness? Management, or is it the board? The board will say, I leave it to management. Management will say, I leave it to when a crisis happens. So who is the main guy?
My view is that it always happens at the top. So the board has to drive this. The management obviously has to implement, but the board has to constantly bring it back to mind. All right. So I have been on a public listed company before, where after an incident, the board realized that they hadn't been paying attention to that area. So the board took upon themselves to constantly bring up this topic at audit committee meetings, at risk committee meetings, at the board meetings. So I think both are responsible. Okay,
that's good to hear. Grace, come back to you. History repeats itself once again and again. And yet we get caught with our pants down. What's your view? What makes a crisis a crisis?
Good afternoon, everyone. Good afternoon, Wanchan, and thanks, SIAS, for the invite again. I think David and both David and Patrick have really, covered very well what a crisis is. But I think from my view, what differentiates the magnitude of the crisis, I'll just touch on a small point which Prue also mentioned in her presentation earlier, is the amount of social capital that you've built up over the years. And that is really points down to preparedness and the hard work and effort you have made in building up the relationship with stakeholders. So with enough social capital built up over the years, you're talking about when in the case of a crisis, it's not just your investors who are impacted, it's your employees, it's your customers. So all of these stakeholders have to be aligned in a belief that we are in this together. It's like, when COVID struck, I think one of the first things that we did was to bring together people, not just from the safety committee, but really from comms to IR to all the operations colleagues together, because we really need expertise from everywhere. So the teamwork, the trust working from home, and the trust from investors, the trust from customers is what you need in a crisis for that to have patience and the time for you to really, for the companies to really focus on what is important and what needs to be done first. And for all of these stakeholders to not jump on, the fact that, hey, my interest is not being covered. So really it's very important that before a crisis even starts, the preparedness, the effort, and to take care of your stakeholders, to build up their social capital is very important. Yeah.
Thanks very much, Grace. So we have preparedness from Patrick and building social capital. So there you have it, dear participants. We have two very, very good recommendations. Be prepared, and it starts with the board, the chairman. And then at the working level, having the ability to build social capital, almost as if you have to tell them that to err is human, to forgive is divine.
Yes.
Let's hear from the regulators, Chin Yi. What makes a crisis a crisis? I mean, everybody is so afraid that whenever they have a crisis, SGX will come down hard on them and say, why were you not prepared? So how does SGX see crises, and how do you advise LeaseCos in terms of being prepared and not to be caught?
Okay, thank you, Wan Chen, and good afternoon, everyone. Pleasure to be here. From the market regulator's perspective, basically our entire structure, our rule, our regulatory frameworks, it revolve around one thing, which is to maintain the trust and confidence in the market. Now that has two facets. In terms of trust, it is about trusting that the participants in the market continue to do the right thing. And secondly, trust that the market operates the way you expect it to operate. So for me, what characterizes a crisis is when one of these two fundamental beliefs are challenged. As we saw in what happened with COVID, an unprecedented lack of access to how you normally do business, to your stakeholders, to your shareholders, to your suppliers. That challenges existing ways of doing business, and that creates uncertainty. And with uncertainty, trust gets affected. So in terms of avoiding a crisis, or should I say minimizing the impact of a crisis, we have to go back to these two fundamental issues. And it all starts, first of all, I think everyone has mentioned today, the culture. And the culture in the market is about both building trust with your other stakeholders, as well as understanding where they're coming from. At RICO, we pay a huge premium in terms of communication, and ensuring that there are open lines of communication between our participants and ourselves, so that we can be sensitive to stress points. Early on in the year, when COVID struck, it was very clear, quite immediately, that the lack of access would prove to be a huge issue for companies carrying on their business in the holding of AGMs, in the releasing of accounts, and this has a corollary impact on shareholders who rely on such information and interaction opportunities. This is clearly potentially a huge impact on confidence. So we work with government authorities, we work with the necessary agencies, MAS, ACRA, and got the necessary legal changes done such that virtual meetings can continue. While at the same time, you try and preserve as much as possible the ability for shareholders to interact with management. And it's by creating and maintaining these channels of communication, and creating and maintaining the trust and faith in participants that not only will the management and directors do the right thing and continue to keep the companies going, and they can have the necessary plans to keep the companies going, also that we are prepared to act fast to facilitate the operation on the market. That to me is what's crucial, on top of what the other panelists have mentioned so far.
Thanks, Chin-Yi. So we got Patrick being prepared. We've got Grace building the social capital, and Chin-Yi, the key word that I hear from you is culture, having the right mindset. And now I'm going to post this to the floor, but before that we'll go back to Prue. So maybe the floor can think about it. How do you measure culture? A culture of preparedness, a culture of willing to build social capital, a culture of wanting to build trust, to having open communication channels with your stakeholders. The culture is so broad. And even the Singapore Code of Corporate Governance says that the board is responsible for building the appropriate culture at all levels. So is that the root cause of that crises comes again and again because there's inappropriate culture? So maybe let's think about that for the panel, but let's go to Prue. So Prue, what makes a crisis a crisis? You're on mute,
Yep.
Prue. Yep.
I'd like to agree with what's been said before, but I'd also like to add to that. I think it's a lack of understanding of risk. And I think management's got the responsibility to pull together the risk register. The board approves the risk appetite statement. And I think what's missing on a lot of risk registers is the E and the S, the environmental and social risks. And that's what Grace was talking about, that social capital. And I'm not convinced that board and management really understand deeply their exposure to environmental and social risks. So, and then the board has to have an oversight of that, and obviously would be reviewing in the Audit and Risk Committee that risk register, but the board also needs to be appropriately informed because cybersecurity is going to be on that risk register for any company, and it's a case of if and not when, as Patrick raised that issue beforehand. And not everybody on the board is going to be an expert in cybersecurity, and neither should they be. But the board has to be informed enough to be able to ask challenging questions of management on some of these difficult topics that they don't have a background in, and to be ensure they understand the responses that they get from management. I think the other thing that can be done is a perception or trust audit of stakeholders. And I think that can provide some very useful information to management in terms of managing these risks. And when I'm talking about stakeholders, yes, that would include investors and financiers, so the providers of capital, but it would also be employees. They're a very important source of information for senior management, and also suppliers. So that trust audit, I think, is extremely important, and that level of trust needs to be high. And if the information comes through that there are issues with trust in your key stakeholders, then management's tasked to try and correct that, and that needs to be done to protect you in when that crisis does happen, rather than suddenly realizing we've got a trust issue in the middle of a crisis, because it's very hard to build trust in the middle of a crisis. When it comes to culture, though, I think culture is really underpinned by values and principles. And that's where it's incumbent upon the board and the senior management team, one, to set those values and principles. And it's when there's breaches in those principles or misconduct that you get the breakdown of culture and poor behaviour, and then that again leads to a crisis. And the communication of really purpose, values and principles throughout the organisation from the top, as we've talked about the tone at the top. And then the management needs to also test that mood in the middle. Is that education getting through there? And the board needs to get enough information to be satisfied that yes, the tone at the top's good because they know the senior leadership team, they've got contact with the senior leadership team, but are they convinced that mood in the middle is right? Because when you think of Wells Fargo, that's where the problems were, that mood in the middle, where the conduct was so poor that 5,000 people didn't know the difference between right and wrong and were creating fictitious accounts. So I don't know what principles they had, but they obviously weren't very sound ones, or if they were, they weren't communicated down to that middle level of management. So it's tough for boards these days, but it is getting that critical information, so as part of their oversight role.
Thanks, Prue. So we got from Patrick, preparedness,
You can't really put a number or score on the culture, but I feel that you look at the number of misses. You look at if the crisis comes about, how you handle, how you how prepared you are, and how you handle the culture, and what is the outcome. So that will show the culture of the company from the top to the bottom is how they dealt with the crisis. All right. So if you're not prepared and you're only interested in the bottom dollar, you're only interested in making money, you're not bothered about, will this happen to us? All right. Are we prepared? If so, what is our process that we have in place? All right. So are we going to overcome this? How are we going to communicate? Should it happen to us? How are we going to resolve this? So all these kind of things, all these kind of items, will indicate the company's culture. Now we are not on the board, right? We are never in the management. We are outside. We are the people who put money in the company. So we are watching how the company has, how it has prepared itself for the risk of a crisis happening. All right. So companies need to, as a culture, need to deal with risk. They need to disclose risks. All right. Having disclosed risks, they must disclose how prepared they are. What is their internal audit, procedures? How are they right from the floor to the top, to the boardroom? What sort of process have they put in place? So
these are the proxies for culture.
Proxies for culture.
Yeah. So this is a good example. So the willingness to disclose risks, the willingness to disclose internal audit, or even internal audit findings. I've never seen anybody disclose internal audit findings in their annual report or anywhere. So we don't know what they've done or what they've covered or even the scope. So maybe with that, Patrick, what's your view on culture? It seems like it's such an important part of minimizing the opportunity for crisis to happen.
Yeah. Thanks, Wan Chen, for that question. I respond to the question from my perspective as sitting on certain boards of this coast, as well as managing a 700 lawyer firm in Singapore and Southeast Asia. I make two quick points. First point is, I think every small thing adds up, is what I would describe as something very important to understanding culture in an organization. So I give you an example. If the company has its directors and management ill-treating the tea lady, the janitors, not giving them respect in their daily dealings, I think that permeates through, it is an indication, and it permeates through the organization. Because I have always been saying that it's very easy to look up to your boss and treat your boss well because he makes the decisions on your remuneration. But it's easy also to ill-treat a person below you because that person doesn't have any impact on your life except to serve you coffee and tea. All right, but people don't understand that corporate culture revolves around small things like this. That if there is true respect, not just amongst colleagues and bosses, but also with subordinates, it reflects on the culture which then permeates. That's point number one. Point number two is, for example, the small things that count will be also how you incentivize your employees. So if you as a board reward outcomes and you pay very little respect to processes and ethics, then what's going to happen is that your employees will know it doesn't really matter how you get there, just deliver the numbers. By the next quarter, you'll be rewarded. You're not going to be taken to task for small breaches, small ethical defaults will not be taken to task. But I think the board sets the cultural tone if they come down hard on not just the outcome and see you've done well, you brought in lots of money, but it's going to be a black mark on you because if you do this one more time, it's not going to be taken well by the board, regardless of how much money you're making for the company. We're not going to reward you for spreading the culture that we do not encourage within our firm.
Yes, Wanchan, let me tell you, only 4.6% of companies from our research disclosed that their board set the risk tolerance and that there was a risk management policy describing the tolerance for various classes of risk. And then 23.9% of companies only disclosed their key risks and how these risks were assessed and managed. And I would say, from this point of view, in these companies, the culture is very poor. Culture of risk management is atrocious. You know, so this is where we are pushing the envelope, right? We are from the ground asking questions, we are posing questions, we are at the meetings, we are sending out questions, and we hope that, you know, the culture will change. But we have companies like CapitaLand and, you know, SIA and the TLCs who are willing to respond immediately, who are willing to improve. I mean, they set the standard, but they're you know, the Premier League. And we have Division 1 not doing also bad, Division 2, 3 all doing very badly. So we got a long way to go to the culture of risk management.
Thanks, David and Patrick. Those are very good qualitative indicator. If a CEO mistreats the tea lady, that's a key indicator of a crisis coming up when something goes wrong. You know, I always say that it's not the rock in front of you that matters. It is a little stone in your shoe that causes pain over the long run.
Yeah, well put.
Thanks, Patrick.
Well put. Agree with that.
Thanks, Patrick. Grace, let's come back to you. What's your view on culture, behavior? Do you agree from Patrick's point of view?
Yeah, for sure. I think it's really toned from the top again. It sounds like a cliche because we keep talking about it, but it flows down from the board and then to the CEO. And, you know, like what David mentioned, you know, whenever there's an issue or a challenge or even a positive thing, like a, you know, like a growth initiative, you know, then it's very clear, you know, when that happens, you can actually see the culture of a company. What kind of effort do they put in to communicate their plans and their disclosures and explain why? And how often do they put the senior management in front of the public, in front of investors, the time that is being given to be transparent and to have an open conversation. So I think that alone, I think it's so hard to quantify and to report culture, but from all these things, I think stakeholders would be able to have an idea, you know, what really is this company about.
And Grace, you talk about stakeholders. How often does CapitaLand engages with stakeholders? I mean, you have investor relations, you have customers, you have suppliers.
Okay, that's something I probably could provide you with some numbers. So for investors alone, I think at the group, and let's not mention the 7 listed REITs, there will be many more, but at the group, CapitaLand Limited itself, I think since COVID broke out, or as of now, we've participated in over 10 conferences.
Wow.
We've held over 50 one-on-ones. In total, we've met over 600 institutional investors and many more retail investors as well. We've held a few, events with SIAS as well. And we also hold our investor day. There's one coming up very soon. So we are very proactive. And because, you know, it's not just about entertaining questions from our investors, you know, it's really, we find it very beneficial when we hear from our investors, whether it's retail and institutional, and they give us a lot of ideas. More and more, I find that this is more like a partnership, you know, the feedback, and there's a lot to learn, especially with, to be honest, institutional investors. They have, for example, sustainability is a big topic. And we exchange ideas, you know, what are they really interested and how can we do better? And I think that's very important. In terms of suppliers, in terms of tenants, our teams on the ground, very active. We do a lot of surveys, you know, especially in COVID, you can actually see we speak to them very much over email, over calls, when people work from home. We try to find out, you know, would you have your, you know, employees come back to work? How often? How soon? So we are very much in tune with what's happening, and that again makes us accountable to what eventually is the company's performance, right? To be able to really build all these relationships with these various stakeholders. Yeah.
So really the ability to demonstrate that communication channel, that willingness to engage is a good indicator of that good culture that you're able to deal with the crisis when it happens.
Exactly. And also internally, I think on a typical basis, we hold staff communication sessions, town halls, on a quarterly basis. So when COVID struck and we had to work from home, we've actually intensified the meetings with our staff, and it's a global event. Whenever we hold our staff meetings, we've done that once every 2 months now, and sometimes even more often if we have any special announcements, and we have a lot of emails going on just to ensure that, you know, all of us are number one, safe, and also about being equipped with, you know, whatever you need, you know, to continue to do your work well. Yeah.
Thanks, Grace.
I wonder whether I could ask Prue, you know, as an institutional investor, how much emphasis do you place on the company culture before you part with the dollar on the company? Do you really look at the culture?
Oh, absolutely. But from a BlackRock perspective, and I don't work for BlackRock anymore, but they are an index investor as opposed to an predominantly index, which means they track indices, and so selling's not an option. So I found myself having to engage with some pretty poor companies that had poor behaviour. But even talking to the active managers, they do take into account culture, but they're looking for proxies for poor culture, which will absolutely be taken into account in their investment decisions. I'm trying to think of some examples. So lack of transparency and disclosure. I think that's what you've been talking to David. Yes. That's a sign of poor culture on the board. Lack of transparency around remuneration, or I think that was raised beforehand. Incentives being awarded when and behaviours not being taken into account in that, and so such a focus on profit at any cost. So there are a lot of proxies that are out there that are indicators of poor culture, poor succession planning on the board, poor appointment of CEO, or not knowing when to terminate the CEO. All of these things are taken into account as proxies for poor culture.
What about whistleblowing?
A good whistleblowing function is critical, and that needs to go to an external body as opposed to the company secretary. And I'm talking large companies here, and I know smaller companies, this is more difficult, but a good whistleblowing policy is absolutely essential and would be something that an active investor would be looking at when making an investment decision.
Thank you.
One other thing I want to add is that I think people are aware of in Australia 2 years ago, there was a Royal Commission into the banking industry because of poor behaviours, poor conduct, resulted in some rather interesting findings. Macquarie Bank actually disclosed, and have been doing this for the last couple of years, the number of conduct breaches in their annual report. And conduct breaches is taken into account in remuneration and how it had impacted the individuals. The individuals weren't named, but how many were counselled, had remuneration adjustments, and how many were terminated as a result of those breaches of conduct.
Excellent.
Thanks, Prue. So maybe a quick recap for the participants so that they know where we are right now in terms of the panel discussion. We started by talking about what makes a crisis a crisis. And here, dear participants, you know, take down your notes. Patrick has spoken about preparedness. That's an indicator. The less prepared you are, the more likely a crisis is going to happen. history does repeat itself, so being prepared is important. And grace is our Miss TLC. So lots of tender loving care, building your social capital with your stakeholders, having the open communication channel will reduce the opportunity for risk to rear its ugly head. We talk about Chin talk about building trust, and he brought up the term culture, which we'll come back to him again in a little while. Prue talk about having risk disclosure, having the ability to build a trust audit with your stakeholders. That's a very important part of helping to minimize the opportunity for a crisis to happen. And David talked so much about our disclosure level in annual reports in terms of risk, and that's a long way to go. So I think crisis is here to stay because the indicator seems like we are still a long way to go in terms of minimizing the opportunities for crisis to happen. So with that, let me go to Chin Yi. So you're the one who started the discussion on culture. Let's come back to you. Now, the code says that we must have appropriate culture at all levels, and the board is responsible. So as a regulator, how do you regulate that?
So when I look at culture from a market overall perspective, I think there are two main facets that we can focus on. One is, of course, you create a conducive structure. And in that regard, the rules obviously play a huge part. And what we've been doing progressively over the few years has been we've been tightening up disclosure requirements in certain key areas of greater concern to investors. These are baseline standards. We're also looking at now the role of professionals, auditors, lawyers, valuers, and working with them to release guidelines, best practices. And through this, you build up a foundation where the market at large can trust that the proper things are being done by the correct professionals according to the correct standards. That's the first part, the mandatory aspect, as I put it. The second part, of course, is having mandatory obligations is never a good indication of culture, right? In fact, if you have too many obligations, it becomes a box-ticking exercise. Exactly, and you don't get the culture. So what we are really trying to do now, and if you've seen during this period of time, starting from February onwards, we've been releasing an increasing array of guidance to board of companies, to directors, in terms of how they can disclose and how they should engage their shareholders. And it's crucial here because as guidance, you hope to breed the consciousness in the minds of the people who need to do the necessary actions. And by then taking the next step, not treating disclosure obligations as a question of what is written there, but by really showing the empathy to know that what is needed during this period of time of great uncertainty is really more rather than less information. Being not afraid, trusting their shareholders to understand what is being told to them, even if it's bad news. That level of understanding can only be bred organically. We'll do our part by giving more and more guidance, and we need companies and directors to understand that where we are really coming from, where they need to come from, is from understanding the needs of stakeholders in the period of extreme uncertainty. And from that perspective, once that is internalized, I feel we are on a much better place. Not to say we're in a bad place right now, but we will definitely be in a much better place because rules can only provide the baseline and the guidance, but it needs to be internalized. And the empathy and the humility is crucial for all the participants in the market.
You know, in the London Code of Corporate Governance, it's required to report on corporate culture. So they literally put it into the annual report. Do you think that the Singapore regime will go along that route where you get people to disclose their culture?
I think it's an interesting concept. And to a certain extent, if you look at how our disclosure requirements have evolved through the years, it has and will always be very majorly focused on the figures, the financial statements, the business updates. That is key. But over the years, we've also introduced requirements for sustainability reporting. And I think this COVID period has shown, especially for investors, I would think, how you assess a company cannot be just in the next 1 year or the next 6 months or so in terms of how they perform financially. The idea of resilience or sustainability of a company, whether it can sustain over a long run, is becoming crucial. And disclosures that are made in your sustainability reports in terms of how you deal with customers, how you deal with the situation. And those are crucial for investors to get a view on not just how the company operates and will operate, but also lets them understand the minds of the management and the directors. And from that, you get an idea of the culture. I personally feel that is perhaps a more fruitful way of developing culture and understanding of culture than just mandating a description of what the company culture is. There are only so many words you can use to describe something that's so intangible.
Yeah,
but actions speak louder than words. Exactly. It's actions and it's how you behave in your disclosure, how you engage, those are your actions. And also how you communicate proactively, making sure it's a two-way street, and giving the necessary information as often as much as possible.
So, so David, maybe I can ask you to comment on sustainability reporting before we go to Prue to answer a couple of questions from the floor from Jean-Luc Aglada. So David, do you think that the state of sustainability reporting in Singapore is where we want it to be, or is it still far from what we want it to be?
We just started, right? We just started asking companies to, report. And I think that became mandatory last year, was it, Chinyi? Was it last year? Yes. And it's a new concept. It requires education, it requires awareness. And companies usually are very keen to do something when they know there will be dollars and cents returns.
Okay.
Yeah, right, yeah. So if I do this, am I going to attract more investors? And let me tell you, not only institutional investors, in all over the world, people are becoming very conscious of sustainability reporting. They want to know how sustainable you are, right? Your business is going to be So I think it is a developing notion, and we have to sell this idea, all right, through a wide awareness program, to an education program. I must say the RegCo and SGX have been very proactive, and they have been looking far ahead. But the bottom line is they need to be convinced that by spending time, I mean, the TLCs are okay, the big boys are okay, but really the mid-cap, small cap, they need to start seriously thinking about why sustainability is very important. How will I attract investors? How much, the point is how much is going to cost me. One CEO glass of beer was telling me, there's a lot of talk about sustainability. We got so much to do, and we got to race. It's a time race, and then we got to talk about the sustainability. And by the way, David, what is it all about? So there you are. There is widespread awareness. There needs to be a better sense of its advantage.
Okay, thanks, David. So Prue, you wanted to make a comment? You want to unmute yourself, Prue?
Again, I'd like to support what David has said, and I do agree that it's important for the small and mid caps, and generally speaking, large cap companies are, they've got sustainability teams, they've got IR teams, and it is easier. But if they do want to attract investors, and even as a director, if you're on the board, I view sustainability as how the company makes its money, not how it spends its money. And as a board director, you really should know the impact of the company's operations on society as a whole, and where there are negative externalities, because they don't appear in the profit and loss statement. So that might be through pollution, it might be through damaging the land or whatever.
How they treat the tea lady.
How they treat the tea lady, exactly. And it's not hard to do that assessment and understand where your negative externalities are and what the company has in place to minimise that. Things like a bribery and corruption policy and code of conduct should be mandatory for all companies. If you're a mid-cap company or a small company, as a director, you would want to make sure that there was an appropriate code of conduct there and bribery and corruption policy, and that was communicated through your organisation. That's not a big expense. Yet I see that's more of an investment. And if you can demonstrate to investors that you understand these risks, you will attract institutional investors. That in turn will increase demand for your stock, and it will lower your cost of capital. So it's unfortunate that many companies see sustainability and sustainability reports as a big cost, and they don't have to be a 50-page glossy document. And in fact, they could just be on the website and updated as needed. They don't need any photos. They need a description and to provide an understanding that the board understands these risks and they're being measured. And it is a journey, and it does take time to build up that whole communication suite. But it's important, and for small and large companies.
It is a journey, Prue. It is a journey. And let's journey across to Patrick. Patrick, you want to say something about sustainability?
Yes. Yeah. Thanks, Wanchan, for giving me the opportunity. I was going to comment on what Prue and also David alluded to regarding sustainability as well as negative externalities, which Prue talked about. You see, as a lawyer, I find it very curious when, let's say you're having a joint venture discussion, that parties are focusing on only all the positives. They talk about how many people are going to be on the board, how we're going to make money, what are you going to do to make more money, what are you going to do to help me make more money, and everyone talks about that. No one talks about the elephant in the room. What if we don't make money? What if we lose money? What if we have to terminate the contract? What if, all right, you are uncooperative? What if the government there doesn't give you that? A lot of the time is spent on the positives, very little spent on the negative externalities as being referred to. And that comes across when we look at sustainability reports, where people are only focusing on the positives. They don't focus on the negative, because maybe it's our Asian culture. We want to make everything look very good. We want to make our company look very good, full stop, right? And so at board meetings, agenda items, I found, focuses a lot on the positives. Very little time is spent on talking about, are you sure? Are you sure? All right, are you sure we can make money? Are you sure we're not going to lose money? And whoever brings it up is being viewed as being a party
naysayer,
a dampener, negative, as you say, naysayer. All right, and that is not very welcome. And you find that next thing you know, you're not recommended for any more board seats.
That's a good point. In fact,
thinking about,
it is. In fact, 2 days ago when we had a panel, somebody recommended that every annual report must have a section called "Are you sure?"
Yeah.
Thanks, Patrick. Really insightful remarks on that. Are you sure? I would like that to be thought about by maybe Chingy as a regulator. Have a "Are you sure?" section in the annual report. Prue, let's come back to you, Prue. There's a couple of questions that has come from the floor. Jean-Luc Aglada has asked a question about the difference between internal crisis and external crisis. Maybe you'd like to answer that question. And then there's a question on the proliferation of fake news causing crisis. And we'll go to David after Prue to talk about fake news. And then we can hear from Grace and Patrick and Chingy about fake news. I thought that's quite an interesting topic from the floor. So Prue, over to you. Internal and external crisis. You're on mute, Prue.
Okay, sorry. So the question is being asked that there are two types of crises, internal, and in terms of internal, it should be, the board should be able to gather most of the uncertainty. I've just lost that. And that it's more difficult when it's an external crisis. Generally, internal crises are caused by failure of governance or the failure of a structure. And I agree, it is probably much easier to get the information to understand what's gone wrong, why it's gone wrong, and what needs to be fixed. It doesn't change the communication that you need to do to your stakeholders. Might be different stakeholders if it's an internal crisis as opposed to an external crisis. The types of internal crisis I'm thinking of would be corruption by a senior executive team, or a failure of safety, deaths on a site or on your premises. And there you would expect a total investigation. And then as from an investor perspective, what has changed to ensure that that doesn't happen again? So the board's really done a root cause analysis of this internal crisis. And then made the necessary changes so that it won't happen again. And as an investor, you've got the confidence that the issue has been fixed as best that it can. I think you're right, for external crises, it can be more difficult. For COVID-19, I think most companies have very little control over the virus. Obviously, that they're not in a position to find a vaccine or stop the virus, but they do have to have systems in place to protect employees, to make sure that employees are safe, which is critical. For an external crisis, you would expect it to have been on the risk register to be identified as a potential risk. Pandemic probably should have been there after we'd had SARS and we'd had swine flu, and so that should have been on the risk register. Probably not as a probable event. Then for external ones, I said on the risk register, and then a plan around that, a plan that's been communicated, scenario analysis if there's a high likelihood of it occurring. So there is a difference between the two, but totally agree. It is more difficult with an external crisis and an internal crisis in terms of information gathering.
Thanks, Bruce, for answering the questions from the floor. David, we'll come to you on fake news. Then we'll go to Grace to hear her views on fake news, and from the rest too. But David, coming back to you, I know fake news is going to be a 24/7 issue. How do you deal with fake news?
And Trump makes it worse. So you see, fake news is a fake news world today. We are living in, so it's coming fast and furiously, right? So
it is.
Let's take listed companies, how they should deal with it. Look at Noble. When Iceberg came up with that research report, they dismissed it as fake news. Was it fake news? It was not. But not all the time it's fake news. And therefore, companies have to have, it's coming so fast, it's going to prejudice investors or it's going to prejudice your stakeholders. You got to reply quickly. So as much as it comes fast and furiously, you've got to be also acting very fast. All right, that's one. To put the truth out there in the marketplace as soon as you can, not sit on it, and don't let it become a monster. That's number one. Number two is that, it's going to cost you if you don't attend to it. Because if you don't, debunk it, there are people who with money going to move away and they're going to believe it. So only way to say it is a fake news is to attack it as the first instance. So you got to be alert. Big companies have got all the mechanism in place, but it is the small fellows who always suffer, right? The small retail investors often get caught by the fake news, and it spreads in the market very fast.
So, you buy on rumor, sell on facts.
Yes. And they invest on rumors.
Yeah.
So they've got to be, therefore, helped by the companies to be expeditiously, dismantling the fake news and putting the truth out in the marketplace.
We'll come to Prue. Prue talk about being cyber warriors, using the digital to fight the war and dealing with crises. So I think fake news is one of them. So Prue, I'll let you think about that while we go to Grace to hear her thoughts on fake news. Then we'll go to Patrick and Jeannie, then we'll come back to Prue. So Grace, fake news is every day. How you can't sleep. How do you deal with it?
So I saw the question earlier, if fake news came with the quotation marks. So I think you really need to differentiate whether it is the real fake news or is there actually some truth to it. So if, as a company, we have a policy not to respond to rumors, right? Unless it is really like what David is saying, it's really impacting the market. But again, I think it brings me back to talking about a company culture. I can't help but, have to talk about a company culture. If the company has a culture of doing timely disclosures, being transparent, being accountable, I think these rumors typically, if they're real fake news, it typically will go away, right? Because people are very aware of, the kind of processes that this company takes in terms of releasing something in an appropriate, in a timely manner, and they're not too worried about that. But if there was some truth to it, and like David say, you definitely need to have it planned ahead, in all kinds of discussions you have, the kind of confidentiality guidelines that you need to have within small group and big groups. You need to already think ahead. And again, the processes come into place even before, the rumors go out. I think you should be prepared for that already. Yeah.
Okay, thanks, Grace. Patrick, fake news,
Yeah.
Lots of legal issues there, you know.
Of course, of course. So in effect, you will recall that in October 2019, the government passed this act, which is having a very long name. I had to remind myself what it means, what it stands for, POFMA. The POFMA, which stands for Protection from Online Falsehood and Manipulation Act. And you may also recall that in the news, there was news back in 2019, early part of halal pork being sold in NTUC. Right, which is of course ridiculous. I mean, there's no such thing as pork that is halal, and then but saying that it is sold at NTUC obviously made people think that maybe it's true that there's other things, right, which caused panic. So that was one example used by the government to justify POFMA. The other one was the Punggol Waterway HDB flats. They showed pictures of collapsing facade, and people were panicking that maybe my flat also has problems with the integrity and the structure, but that was not true. So you're right, definitely a huge issue for companies as well, not just governments. So POFMA, however, you must understand, is limited in application. POFMA is used mainly in the interest of the public. So companies' falsehoods may not fall under POFMA, although in some cases, some companies of substantial influence and size that whatever statements made about them could impact the public interest, in which case POFMA could be used as a quick and ready fix. The second area that one can deal with is the thought of defamation. But I always caution clients who resort to defamation that you better look to see the other ways to solve the problem, because the defamation suit takes time, takes effort, takes resources, and the most important, it may open up other areas of inquiry that even if you win the case, you may lose the war. All right, and the famous example is that of the author. Yeah, it's a famous author, Oscar Wilde, who lost his entire fortune after he sued somebody for defamation, which turned out to be true. All right, so David's point is well taken, that don't anyhow sue if you are not sure of your position ultimately.
Or NKF.
Or NKF, that's a good example too.
So Patrick, what would be your advice for corporates? Should they set up a legal apparatus internally to be ready to act? Or should they be a bit more circumspect about this kind of false news and say it is what it is?
Yeah, I wouldn't recommend spending too much resources, legally speaking, on handling online falsehoods. I think there's time better spent making sure that your PR and your communications is done positively, rather than, as Grace alluded to, responding to every rumor and statement. There'll be you'll have no time to do your work if you're spending all your time dealing with all those issues. So I think to be practical, one needs to have a mechanism where you have a website where you can respond clearly and succinctly to issues. You have to engage the media as and when it happens to be able to explain the background so that the media can help you respond as well.
More tender loving care.
I think so.
Okay, let's go to Chin Yi before we go to our cyber warrior Prue. Chin Yi, what's your view? Should there be a POFMA for listed companies that they can invoke?
No, I mean, technically there is a form of POFMA in that if fake news is spread with the intent of making the price move, I mean, that is actually a criminal offense right now.
It is.
So in that sense, the protection mechanisms are somewhat there. And my thoughts on this are just mostly similar to, I think, what the panelists said and what I said earlier. A lot of it is about how the company has inoculated itself. Because fake news always only really works when, there's sufficient credence given by the majority of the public. And that only happens when there's a vacuum in terms of the information. And
not
if
transparent, yeah.
Exactly. If as Grace said, you are being proactive in your disclosures, and if the disclosures are detailed, especially in this kind of period, where there's all sorts of potential rumors flying around about the impact on your business. If you are being already very transparent, very detailed in analyzing how your business may or can be impacted, how you intend to get through it, you remove the ground for a lot of the fake news to proliferate. And then after that, it's as Patrick said, I mean, there's some wild out of the blue allegation there. You just have to deal with specifically if it gains credence.
Thanks, Chin Yi. And now let's go over to cyber warrior Prue. How do you put on your armor to deal with fake news so that you can prevent, reduce, minimize a crisis?
Yeah. Well, first of all, you want to try and prevent it. and this is leveraging or what has been said, particularly by Grace, but having that relationship with your stakeholders, particularly your key investors. So you're starting with that point of trust with your stakeholders. That transparency and regular disclosure of relevant information, again, what Grace referred to. So your stakeholders consider that as being the trusted source. They don't really need other sources because this is the trusted source from your company. So that is absolutely important. Being on the front foot in the crisis, don't wait. And I think quite a few of the panelists have mentioned that. Don't delay. So be on the front foot. But also look at the different types of media sources, particularly digital, that you can use to get your message out there. And I think this is one of the things that's changed in the last 5 years in terms of communication. So I think I can sum it up in 2 words: trust and be proactive. I think that the 2 sort of words sort of sum it up, if that makes sense.
Do you believe that every CEO must have a LinkedIn account or an Instagram account?
Not LinkedIn, not necessarily. I think LinkedIn, it can be a good tool, and that could be a company LinkedIn account. Twitter can be used very effectively, and this is what investors are using. So you've got to look at also the sources of information. Where are your stakeholders sourcing their information? And you need to be right across these. Now, I'm not a specialist on Twitter or the others. Yes, I have a Facebook account. But if your investors and your other stakeholders are sourcing their information on these media platforms, you should be too. Do not ignore them and don't be scared of them, but get the right advice about how to use them appropriately, I think is very important.
Keep your friends
close. And we do know there are some people who don't use these media platforms appropriately.
Yep. Through your presentation, talked about stakeholder engagement of crisis and engaging stakeholders. We got about 20 minutes left to the presentation, and participants, please do post your questions to the floor because we got about 20 minutes left. The next question will be on stakeholder engagement. You know, in the Singapore Code of Corporate Governance, Principle 13, the newest principle that we added is called stakeholder engagement. David, maybe we start with you, then we go to the rest of the panelists. How should stakeholder engagement be done in order to minimize, reduce crises? What's the best practice for stakeholder engagement?
You know, in the distant past, in the 90s, in the early 20s, no one thought about this very seriously. But companies have begun to use this as almost their culture, you know, wanting to engage stakeholders. So Investor Day and dialogue sessions are becoming the norm. The companies are coming to SIAS. Instead of we calling companies to meet shareholders, companies are coming to SIAS asking, can we please use your platform? Can you help us to arrange a dialogue session with? So we did, as I said, 47 dialogue sessions within 18 months. And much more will be coming. So there is now a willingness to, amongst many companies, to meet shareholders face to face. And they find that very useful. And meeting shareholders, not once a year at the annual general meeting, but in between, all right? In small numbers, in big numbers, they're able to get to know their shareholders. And shareholders, when they meet face to face, their CEO and CFO, they get a lot more, and they settle down very clearly, very easily. They settle down. They don't worry about fake news. They don't worry about, you know, what others are talking about the company. They've heard the horses. So that is being appreciated by the boards and the senior managers. Okay,
David, so, who should you think should be responsible for stakeholder engagement? Who should be the chief stakeholder engagement officer?
Well, the investor relations, you know, department, if they have one. If not, they do have investor relations companies that advise, you know, the board. It is the board's responsibility. It is
so from a broader stakeholders, not just shareholders, but stakeholders as a group, big group.
Yeah,
the board is responsible.
Yeah, we talk about shareholders, but the board has to get the management to engage with the other components of the stakeholder group. All right. So you have maybe the bondholders, you have the institutional investors, you have the shareholders, you have the suppliers, you have various partners, all right, who are stakeholders. So that's for the board to decide how effectively they will keep them informed and keep them together and near, and not allow them to be, at a distance. So that's very important. And companies, successful companies, I mean, Grace will tell you how often they worry about this and how well they execute, stakeholder engagement. They won awards. So has, other companies like Singtel and big companies. So other companies are learning. They are learning that they need to meet stakeholders regularly. SIAS is about shareholders. And we find there's an increased demand on us and an increased awareness of wanting to connect with shareholders. All right. I know there's a lot of complaints that it should be open to media. It should not be just between SIAS and the company and shareholders, but that's how the companies want it, and that's how the shareholders are able to ask questions freely, and without the publicity. They can be frank. They can scold someone very politely, but at the same time ensure that it is not being reported. So I think I'm very pleased with the current situation, that there is increasing requests, increasing awareness for stakeholder engagement.
One more question for you, David, before we jump over to Grace. I mean, I think CapitaLand is really on the forefront of stakeholder engagement. So David, would SIAS go beyond shareholders and talk about stakeholder engagement as part of your remit?
Well, we are covering other categories of investors, because our constitution talks about serving investors, but we expect the company to, and we don't need to prompt them, but the companies need to know that there are other groups within the stakeholder groups that need to be reached out to. Yes, at annual general meetings, shareholders can ask, have you been reaching out to the other stakeholders? All right.
That's good, David. That's good to hear.
Important. And we've sent questions about stakeholder engagement. So companies will more regularly will be asked about stakeholder engagement.
Thanks, David. Grace, stakeholder engagement, Principle 13. Your thoughts? How does that help in crisis management?
I think I mentioned earlier that in a crisis, you really need all your stakeholders on board, because it is not just a single group, it's not just your shareholders, but really what keeps the business sustainable is also your customers, your tenants, your employees. And therefore, this stakeholder engagement becomes very important. And just now you were asking, who should really, be
the chief.
Responsible. And I think it's the board holding the CEO accountable. So for us, the CEO has a set of KPIs, and it flows down to all the different business units, and then down to every employee, whether it's at a mall, how you engage your tenants, the needs of the tenants, all the way to shareholders. And in order to deliver performance, financial performance, you really need to have all this, your employees, upskilling, that's employee engagement as a stakeholder group. You have your tenants, what their needs. And I think COVID really provides us with an opportunity to really look at this holistically, basically the report, having these regular conversations with each of these stakeholder groups. And without, understanding the data on the ground, what's happening with our tenants, I'm unable to report to my shareholders, right? And then they will lose the trust. So it's all interlinked, and it has to be a virtuous cycle, and definitely if you ask me who's accountable, it has to be the CEO, and then it flows down to us. So all of us are accountable.
I like that very much, Grace, that the CEO should be the chief chief stakeholder engagement officer. Patrick, what's your views?
After us, I think he believes in that.
Patrick, is the CEO?
Yeah, I agree with that. I mean, I feel that at the time of crunch, this is where the CEO's job, I mean, he's really, really deserving of the pay he's getting, whether people feel that this is a justified pay or not, which is always sometimes a source of debate. I think in crisis, this is where the CEO can really show that he deserves the pay, because I think in a time of crisis, you need that strong leadership. And strong leadership cannot, in my view, come about in a crisis through democracy. You cannot end up having everyone one vote and then just go with the one vote that result that comes from the vote. I think you need clear leadership, you need clear thinking, you need coordination, and you need speed, which cannot come, unfortunately, through a democratic process. It has to come about through a process where leadership is good. Having said that, I think there is a lot to be said about engagement in peacetime. All right, I think when time comes to crisis, it can be too demanding to ask the CEO to be the one person that solves everything. So to be able to have engagement with stakeholders in peacetime helps the CEO when it comes to war to be able to already have the relationships, to be able to decide who to prioritize. I mean, everyone is important, right? But you and I know in a crisis, no one can be everywhere at the same time. So at the end of the day, somebody has to decide to say who is more important than the other important guy. And at the end of the day, that priority is important, because if you look at, for example, employees in a crisis, it's quite often said to the employee will say, I didn't hear that, I heard that from outside. I didn't know from my bosses. I mean, I heard from outside. And that would be a very bad indictment on management if all employees hear the news from outside and not from inside.
Great words, Patrick. Good contribution to Sun Tzu Ping Fa, to the Sun Tzu Art of War.
That's right.
Chin Yee, let's come back to you. There's a question on fake news, but can I hear your views on stakeholder engagement, Principle 13? How do you encourage companies to adopt Principle 13 so that it's part of crisis management, like what Patrick said, peacetime engagement and wartime engagement?
Yeah, I think I totally agree with what they said, and it's really about the trust our social capital you build up with your stakeholders during your peacetime, such that when the hard truths and the hard choices come out during wartime, you get their support. And that's all it is at the end of the day, the support of stakeholders. Because from a market regulatory perspective, you do have a multitude of interests that you have to balance. For the interest of stakeholders in being informed, in having the access to information, and the interest of the company, the issuer, in the need to get on the business of surviving. And in terms of how you regulate, every single piece of regulation we put out has to seek to balance these two sometimes competing concerns. And I think we can only do that if we have already built out that social capital, not just between us and our issuers and the investors, but also where there is the correct social capital between the company and its investors, where everyone understands that some compromises have to be made in a crisis. Because as Patrick has rightly put, it is where you need the speed of action to deal with the immediate challenges. That's crucial. I would say one more thing though. Once that is passed, and I think we are maybe moving into the medium stretch of this particular crisis, the compromise balance has to shift as much as possible back to an optimal position. For instance, if you talk about in terms of shareholder meetings, from a situation where you could have no social gatherings to now where you can have limited social gatherings for the sake of meetings, to another situation where perhaps there's no more social distancing measures. How do you still leverage on the benefits of having a hybrid of virtual style meetings where you can get far more participation, but yet not compromise the quality of engagement, which can only come when there is actual form of face-to-face communication? I think those are the challenges that we face right now that we'll have to resolve in the future. But consciousness of it being articulated out, being acknowledged by everyone, that helps, that builds that trust and maintains that trust throughout, before and after a crisis.
Okay, thanks Chin Yee for that. A quick question on fake news, question from the floor from Alvin Lim. Can companies use the SGX platform, SGXNet, to post their replies and clarifications on fake news?
Yes, but of course, the disclosure obligations are very clear. Companies have to make disclosures on anything that is material. That includes clarifying that there's nothing material. If, for instance, you see prices or the market reacting on any given day. And SGX does issue queries in that regard. So for instance, in the case of short seller reports, we have publicly stated we expect companies to post clarifications to clarify any of these allegations that come up. And in the interim, halt their trading of their shares while you give the necessary clarity to the market. So in that regard, if a piece of news is widely circulated, it has potential and manifest impact on the stakeholder confidence in the company as seen by trading activity. We would expect clarifications to be posted as an announcement or actually as that.
Okay, thanks, Xi, for that clarification to the question from the floor. Prue, come back to you before we got about 10 minutes left. So we'll come back to the rest. But Prue, would you like to comment on stakeholder engagement, Principle 13?
Sure. I'd like to support what has been said before, particularly about the peacetime engagement. That's to build up the trust. But in times of a crisis, I think it's important for companies to form a cross-functional team that has insight into all stakeholders. And such teams need to meet regularly and need to have a good communication feedback to measure changes in perception of stakeholders over time, because as that engagement takes place during the crisis, there's communication during the crisis, the perception of the stakeholders will change. And they need to understand that not only will stakeholders perception change over that time and also during the course of the crisis, but also reassess what their views and perceptions are. But there's one blind spot that I think this was touched on previously, that companies tend to focus on those noisy stakeholders. You know, the squeaky wheel gets the oil, and that does tend to be investors and the media, and they may not be the right stakeholders to focus on depending on the circumstances. And you know, they tend to forget other stakeholders, particularly employees, and I think Patrick touched on that, but also customers and suppliers. So I think having that cross-functional group within the organisation, and this I guess would apply to a larger company, to get that feedback and that continual assessment of stakeholder views and perceptions during the crisis and as the crisis is being managed is very important.
Thanks, Prue, for that. So we got about 10 minutes left. Let me summarize the discussion from the panel. Really great responses, great feedback. While I've summarized, maybe the panel can think about what's your Christmas wish for this year. May not be related to crisis, but it could be getting a vaccine for COVID-19. But what's your Christmas wish for this year so that we end on a happy note? And I know Santa Claus has a crisis up there because nobody's buying stuff. But the award for tender loving care goes to Grace for the best responses on how to engage with stakeholders, open communication. So one way to minimize crisis is tender loving care, and that award goes to Grace. The award for Mr. Preparedness goes to Patrick. Be prepared, because if you're not prepared, it's a proxy for disaster coming down the road. And I will also give him a sub prize of Mr. Sun Tzu for having wise words on wartime and peacetime. Mr. Culture, I'll give to Chin Yi for saying that culture is important proxy for crises, that if you have the wrong mindset, it can lead to a crisis happening. And for Prue, talking about the trust audit with stakeholders, I'll give that prize to you for having the best idea in the panel discussion. And for David, I give you the prize for Mr. Risk Management. You know, for a country like Singapore, we don't talk about risk management. I think that's kind of surprising on many fronts. So maybe we come back to Grace and Patrick. Grace, what's your wish list for Christmas this year?
Okay, I think COVID, right, the situation that we are all in has really, put us in a situation where we can actually assess, or differentiate the sustainability, or the prospects of sustainability of businesses. So I think my Christmas wish is really to have those that have done a lot of work, have been very prepared, have engaged our stakeholders to be rewarded much more, than, I mean, if you can see the differentiation, to reward those companies by investing in them. I think that would be my Christmas wish.
Excellent. So annual reports prepare us. Please prepare to tell us stories on how are you prepared for COVID-19. Thanks, Grace. Patrick, any wise words for Christmas?
No, my Christmas wish actually is a lot more simple, but it's basically I really hope that international travel will resume in some shape or form, because my own anecdotal dealings with clients is that it has affected the mergers and acquisition markets, because no matter what you say, when you do a JV, you need to meet people to understand them, to shake hands. And so I think international travel, if we can resume back to normal, will help our fabulous airline, Singapore Airlines, to come back again. It will bring back life, it will bring back tourists, it will bring back a lot of things which I think we miss and we took for granted in the past. And so I think that's my biggest wish for travel to return.
Thank you, Patrick. Excellent. Chin Yi, what's your Christmas wish for all of us from yourself, from the exchange?
haven't had a chance to think more than 2 days ahead. But in terms of Christmas wish, I think what I've seen, and it's very encouraging for me personally as well as professionally, is that with the influx of retail interest in the market and a lot more retail shareholders, you see a lot of board of directors stepping up in terms of, I think this whole topic we just discussed, how much detail to give their new stakeholders, new and old stakeholders, and how to better engage with them. I think earlier on someone raised the example of the SIA CEO and in terms of the rights issue, and these are very positive things. And my Christmas wish, if any, is that the more retail are in the market, they're not going away. And I hope that this wave of consciousness I see among the boards of the listed companies, it goes beyond whoever we've noticed it in so far, and it permeates the whole market. That makes the market far better and more sustainable in the long run.
Thanks for the nice wish, Chin Yi. We'll go to Prue, and then we'll end with David for closing words. Prue, what's your Christmas wish? I mean, Christmas comes first in Australia because of the time zone. So what's your Christmas wish for us?
Look, very simply, a vaccine for COVID-19. I think that is so needed. I'm desperate to travel to get up to Singapore and Hong Kong again, so we can't travel without it. And I just hope that it's very close.
Peace to the world. David, a couple of closing words. A couple.
Yes, I think the panel discussion this afternoon has been very, very enlightening. A lot of good points were brought out, and I think company personnel, especially the senior management who are listening, will know exactly what we've discussed needs to be done. But my Christmas wish is that Singapore and all countries where COVID has, been the problem, they will be rid of it with the vaccine, and we all can travel and go to the restaurants we like, have happiness and peace and enjoyment as we had before, pre-COVID, and finally that I can go to Melbourne to be with my 6 grandchildren and my children for Christmas.
Thank you, David. And with that, any last words from the esteemed panelists? It's been an intense 2 hours presentation from Prue and the remarks from the panelists. Many thanks to Prue for the presentation. Patrick, taking time off from your 700 people around the region, being the managing partner of Raja & Tan. Grace, taking time away from your beloved stakeholders for contributing today. Chin Yi, from being away from the exchange for the last 2 hours. And David, being away from all our investors in the market.
Thank you. Thank
you.
you.
Thank you very much. Thank you.
Thank you. Thank you very much. And Richard Dyson, you can come back on to close us off.
Thank you very much, Wan Chen. And a few years back, we actually did even a rating. We had this GEMS research. We actually even graded looking at the behavior of companies. So I think maybe it's about time we actually bring back some sort of ratings of companies' behavior on governance. Thank you very much, panelists. Thank you for your insight, and thank you very much, ladies and gentlemen, for joining us. Have a good evening.